Good morning to everybody. Good afternoon to our colleagues in Asia. My name is Nickolas Reinhardt. I'm a director at Afore Consulting, and I'm also honored to be the chair of the EU-Asia Financial Services Roundtable. For those who are unaware of our organization, we are a trade association in Brussels, focusing on promoting regulatory and public policy debate between the Asian region, however broad defined, and the EU, specifically on financial services related issues, as I said, regulation, but also macroeconomic aspects and broader considerations. I think what's very important is that when we look at the development of public policy, particularly from a European perspective, that we don't just look at the EU itself and don't focus alone on the UK and the US or Switzerland, but that we also remember the implications for Asia. And equally, I think it is important as we think of policy in Europe that we should not overlook the incredible dynamic developments in the Asian markets, both from a macroeconomic perspective, from a technology perspective, and from the evolution of financial services. And I think the latter point is the one we want to raise and discuss today, because despite any geopolitical questions that might arise or not, it's undoubtable that China as an economic and political power is on the rise. And it is interesting to see that significant efforts are being made in China to reform its financial markets, to grant more and more access to third parties, even though that might not be always perceived. And we thought it would be useful to have three experts give us a sense as to how the markets in mainland China are evolving. And we did a similar seminar a year ago, which was very well received. So thank you very much indeed for our speakers for being there with us today. Before I introduce the speakers, I would like to just remind all participants this is an interactive seminar. So really we're doing the seminar for you. And we would really encourage you to intervene, ask questions. And there's a number of ways you can do that. I will remind you throughout the session, but there is, of course, a Q&A function in Outlook. So if you, in Zoom, in Zoom. If you would like to ask questions, just put them in there, or comments. Or if you would like to be brought into the discussion, my colleague Andy, who's sitting next to me, will bring you into the discussion interactively. We would really appreciate that. Or you could alternatively also raise your hand or communicate directly with Andy. So hopefully we can have a lively conversation. With that, we've got three presentations lined up for you, three excellent presentations. Kicking us off in a moment is Florence Lee, who is the head of Greater China Business Development, EMEA Markets and Securities Services at HSBC, who will kind of talk us through some of the broader market developments in China, but with a particular focus on equity markets. And I'll pass over to you in a moment, Florence, because I know you will also share some slides. Secondly, we will then, after a bit of a discussion, pass over to Lirenn Tsai, who's Managing Director, Head of Products and Sales in Asia for Tradeweb, an electronic trading platform and provider of trading services. And the focus there is very much on bond market developments and Swap Connect, very much the unique structures that China is developing and developing bilateral regional trade cooperation, which has been quite successful in the recent years and is being expanded to more and more products. And thirdly, we then have a slightly broader outlook on the fixed income markets in China, and that will be provided by Celine Luo, the Executive Director, GCNA, Structuring and Financial Markets at Standard Chartered Bank. An excellent lineup, and thank you very much for all of you who are very busy for taking the time. Last but certainly not least, I would also like to introduce Jennifer Keser from Tradeweb, and who's the Vice Chair of our EU-Asia Financial Services Roundtable, who I know will kind of close us out at the end, but I trust will also be actively involved in the discussion. With that, thanks to everybody for joining. And maybe, Florence, I pass over to you to share your screens and start talking us through the broader perspective on China and particularly what I think is very exciting, the developments in the equity markets.
Certainly. Thank you, Nickolas, for the introduction. And first of all, thank you for inviting HSBC to join this very useful and meaningful discussion with the industry participant. I'm Florence Lee, heading on the Greater China Business Development for the EMEA region. Today, we are very happy to update you about focusing on the China equities market. I think for China, there's no short of topics, no matter good or bad or anything on the media, and then always catch the headlines. Today, the discussion also, we are pretty much focusing more on the regulatory side. And also I will share with you some of the observation we see in the trend in the market, and also how this development impacting some of the thing in particular, hopefully that is more focusing on the European side. So let's start. I think this is a data that is want to give an overview, because after China has been going through COVID for the last 3 years and so, and then finally late last year, they start gradually opening. And then in 2023 is a big opening. So almost like overnight, everything is resuming. And but in terms of capital market, you see the on the top left-hand side, that is, you see the chart about the market cap. China is still #1 in Asia, and then also compared to Japan or Hong Kong, in terms of the market, it's a very big market, cannot be ignored. And also, if we compare the market cap to individually to some of the key market in Europe, you see that in the UK, in France, Germany, and Euronext as well. So this only gives you a idea what is the current size of the China capital market in terms of the, this is only equity only. And also, if you see the lower bar chart about foreign ownership in the China capital market, this data is only captured up to April this year, 2023. But there's a trend I would like to also share with you, which is, I think, most of you are also aware of. Last year, 2022, is a very, very difficult year for running the China business. And there is many factors impacting in terms of the, we see foreign capital has been a significant outflow from China. And this is due to quite a lot of reasons. I think the very strict COVID has been affecting the confidence to some of the international investors, because at that time it's still not very clear on how long it will take and whatsoever. And also this, of course, impacting the local economy in China. And also you think about a few things as well that is happening during that. We have the Ukraine war, the Russian attacking that is already started in that year. And also about the interest rate hike. And then quite a lot of asset has been going to, flowing to other market as well, no matter for safe haven or no matter for higher yield. And we see this year, 2023, is a very mixed bag. Why I would say so? Because if you still remember when China announced, okay, now we will ditch all those COVID restriction, the quarantine, lockdown, whatever, they will encourage everything is resumed back to the normal. And this is a very, very great news to the market. And there's a huge surge in the just one single month, January. If I can give you some proxy about the data, that is, if you're looking into Stock Connect, it is using the Hong Kong platform to buy the China A share. If you're looking into Stock Connect northbound in that particular month, it's a single month inflow, net inflow of about 141 renminbi billion. So this is quite a significant amount. However, this good news, I think, is a very short-term boost, if I could say so, because if you're looking the following months after January, the data is relatively quite weak in terms of the net inflow we can see some of the money single digit, only less than 10 billion inflow, net inflow into China. Some other months, even you see a outflow as well. It's the capital net outflow. Particularly, we have the data from Hong Kong Stock Exchange up to the end of August. August month is the worst performing month in terms of capital flow into China, because I have recorded in a negative, which is a net outflow of 90 billion renminbi. So all in all, I think this year will be still a challenging year for the China, because I also declare I'm not an economist, and I'm not the analyst for we have our HSBC Global Research, but from our research report, we already lower the GDP growth for this year, for the whole year. And secondly, I think for the stock market, when foreign investor particularly, they have to regain the confidence and also finding China attractive. There's a few things more to be seen happening. For example, some of the stimulus package from China. And also, I think the weakening of renminbi also is one of the factors making international investors to reallocate their asset to some other market. But however, will that be gone forever? I don't believe so, because as I show you, this is a very big market. And then we can still see that there's still some of the inflow and also some other client to support this. The next slide I would like to show you is QFII. So I will not go into very detail, because I think most of you are quite familiar. This is one of the schemes that is allowing a foreign investor, almost like a domestic investor, you can trade, you can buy quite a lot of different types of securities under this QFII license. For example, you can join the IPO, you can trade. On the right-hand side, you see the investment scope. I have already helping quite a few clients that is trading commodity futures. This is one of the quite hot topics in the last 2 years. We've quite received inquiries. And next, I also want to supporting one of the argument about will international investor gone forever. I don't quite believe that, because you see that on this bar chart in the slides, you see that this is the number of license approved by the Chinese regulator, CSRC, on this particular program, the QFII or RQFII, or we now combine it, call it just QFI, QFII. You see in the last 2 years, 2022 and this year, 2023, there's still investor applying for this license. And it means that for some of the investors, they still have their long-term strategy. They would like to be ready to trade in China, no matter equities or some other, like I say, commodity futures, or they want to join the IPO. We still have a very healthy pipeline at the moment that is for international investors. They would like to be partly to join this QFII investment. And also, so far, CSRC has approved 778 licenses to international investors around the world. And HSBC have been our local custodian, has served out of those 708, that is 273 is under our custodianship. And there is about 131 is a European entities out of this 700 investor or this license. Okay, next, after we talk about QFII, another channel we know that can buy the China A share will be using the Stock Connect. Stock Connect has been a very well established and easy to use channel if you're only looking for some of the cash equity. And that's why this has been very popular among fund manager, hedge fund, and so on. But this year, there's also quite a lot of changes as well. Stock Connect has been, I think the most significant one is the eligible securities. We saw that they has been expanding the scope of the Stock Connect. Northbound meaning, because Stock Connect is a two-way program, it have northbound and southbound. Northbound is meaning international investor can go to Hong Kong using the Hong Kong Stock Exchange to trade China A share. And southbound is the other way around. That is for Chinese domestic investor they can come to Hong Kong to buy the Hong Kong listed shares. And these I'm showing you is focusing on northbound, which is for international investors' interests. They have also including those shares, as I say, eligible security has been increasing. Those over 5 billion RMB market cap, then they will be able to join as well. And then in that way, you can see that some of the, because in China, I think particularly most investors, they will be looking for those in the sector of like with technology or life science, and also for quite a lot of the, especially around the Shenzhen Stock Exchange, that is for the technology part. That is one of the, and the EV is quite a lot of those is talking about. And then I think these are the attractiveness, and they're increasing it as well. And the lower part, you see the bar chart has been showing the comparison after increasing the deep red bar is the current before the increasing the market cap, those share, and then you see it's quite significant. The main board is, the first one is Shanghai main board, and the second one is Shenzhen main board. But we also have to focusing not just the main board in China, because quite a lot of the with good potential business or the enterprise, actually you can find in the star board, which is part of those listed in belongs to the Shanghai Stock Exchange. And then also Chinex is very similar. They are for the smaller cap, and then up and rising star that is in the Chinex. So these are also, sometimes we find that international investor, they really drill into those particular sector, as I mentioned, for those like high-tech EV or the pharmaceutical or life science. So this will be quite popular to find there. Okay, next. This has come to the regulatory side. I would say since last year is a busy diary because Chinese regulator have kept on opening up the capital market. And here is because of my topic, I only share with you is focusing on equity related one. If you are talking about the whole universe of Chinese regulation, I can tell you for 3 days. And so that's now concentrating on the equity one. For the top few, I think I will not go into really detail, because last year I already mentioned GDL has been already very successfully expanding to Switzerland, not just in London, in UK, but also Switzerland and Germany now is also part of those for the GDL program, or we can call it Europe-China Stock Connect. And also, I already mentioned about the Stock Connect expansion that is happening in March this year. In that way, that is in both northbound and southbound, there will be more different types of shares can be chosen by international investor and also China as well. And under this, even though southbound is not related to international investor, but I also want to highlight in my point, the second point about southbound. There's also some of the international company listed in Hong Kong now is start to be eligible to put in the southbound. It means that as a Chinese domestic investor, I really like certain of those international company. Of course, I will be quite difficult to go to other stock exchange to buy because of the restriction on the currency. But they can, through this program, the Stock Connect southbound, to buy those very high quality international company through this program. At the moment, it's still quite small, the scale, but this is a very good testing ground. And also you may hear on the news that is Hong Kong Stock Exchange also very proactively approaching different company for dual listing or listed in Hong Kong. This is part of the reason, because when those company can choose to dual list or listing in Hong Kong, and also if they will be eligible to the Stock Connect southbound, it means that their potential investor to buy their share will be increasing a lot, because that is including those Chinese domestic investor. Okay. On the IPO as well, China has now, in the past, they have a lot of different way to do the IPO process. The traditional one through the filing is quite a well known for time consuming, and the process is quite a lot heavy in the documentation, and also the process is quite slow. Sometimes take more than a year or years. But now, but also they have a different approach in the past. That is, for some startup, they can only registration. So now they aligned it, and then to make all the main board or the other the Chinex boards and so on, they will be in using this registration process IPO, which is a very good news, because that will be making sure that yes, the potential issuer will be getting faster in the track, and then to also helping on also unify the national IPO market standards. I think that will be a very good impact. And also, that is a Chinese firm that is, if they want to try to listing in the offshore, they will have to, including those VIE structure, they need to file the offshore listing proposal covering the intent listing destination with regulator. This is starting from March 2023. And also, I think in the past, there's a lot talk about Stock Connect have a different trading in Canada, because when Stock Connect can be open, it must be both Hong Kong and China has to be open at the same time. Because at the moment, still Hong Kong bank holiday schedule compared to China bank holidays is not synced. So it means that some of the days when one side of the market is open, the other side is closed, then it's not a Stock Connect day, it's no tradable. But now they have, this has been lobbying by the industry for a long time, because especially when the market have a major movement, you see that the China A-share in China is trading, but Hong Kong, because of bank holiday, is suspend the Stock Connect. So that's why they're adding 3 more days now to further improve this. And there's still room for improvement for this one. Dual counter listing, this is a very good one as well. It happened in June. It means that now you can also settle in both RMB and Hong Kong dollar in that way. It also accelerates the Hong Kong as the offshore renminbi center as well. So I highlight here that yes, this is really hot off the press, and then it just announced in August about some of the package and also the changes. One of the things that is, this is now under the Stock Connect, it will be allow block trading, which is helping to the execution of large size privately negotiated transaction. And then also it will have more certainty on the pricing and the execution as well, which is in the past not happened in the Stock Connect. And also in the end of August, you see that in China, they have their tax authority has also confirmed that they will be have a big reduction on their stamp duty cut. Is a half price, 50% off, and then it will be changing from, it's already effective because it starts from the end of 28th of August. And also the margin ratio has been lower as well. Another fees, which is including this also related, is the stock exchange levy fees is also reduced, also on the same day. You see both the stamp duty and the stock exchange levy has been quite significantly reduced. This is also partly they want to revitalize the market and attracting more, no matter is the domestic transaction or the foreign investor coming over to China. And CFEX, CFFEX, that is, they will be drafting, and then there will be another stock index future and option coming. And then at this is a drafting stage. For the rest of the year or next year, so there's a few things I would like to highlighting, then we will be going to look for that. That is to facilitate long-term investment into the stock market. There's some of the further, the equity funds, they will be relaxing the registration for this kind of index fund as well. And also cutting the management fee of the public funds. I think all in all, this is in favor of the investor side. And then the no matter the stock exchange or the Chinese authority would like to making more vitalization on this stock market. there's two other, then I will not spend in too much time on that as well. But all in all, I think you can see that in this whole list of the regulatory changes I just shared with you, that is the Chinese authority have a determination to further open up, and also they hear the lobbying from the industry and also from the market participant for the long time, and you can see it keep coming up. And then we're expecting there will be more to come in the next 12 months or so. And the next I will very quickly, but will not spend too much time because this is related to Europe as well. It's about the GDR, the Global Depository Receipt, that is for the Chinese company launched in an issue here in Europe. And for this year, I think since last year, we see quite an active issuance happening in Switzerland in the 6th. And it's a very encouraging symptoms in the last year. So this is some of the very data I would like to share with you. And you see that on the top left-hand side, that is used to London, the London Stock Exchange is the only venue that is happening, have that. But now you can see that this is including the pipeline and everything, that is Swiss Stock Exchange has really surpassed and then be the leading destination for Chinese company issuing GDR. Last year, they have launched 9, and then there is a further in this year as well. In terms of the changes as well, and then we see that there's quite a lot of the different types of company in terms of segment. You see the lower right-hand side, that is since the 2022 is really a big change about the GDR in Europe. In the past, it's only traditional one, but you see that since 2022, the industry will be mainly is the EV battery, machinery, renewable energy. And also, I think this is also very aligned with our ESG agenda in Europe, which is a very top priority in here in Europe as well. However, there's changes as well. And then you see that as I say, 2022 has been quite significant. On the left-hand side, that is the bar chart and how much capital has been raised. You see that is from 2022 to 2023 is reducing. And also you see the drop of the number of listing, because 2022 is the highest one. We have close to 10, but now it's dropping. What is the reason for making all this happening? So there's a few things happen over the years. That is in early this year, that is in May 2023, CSRC have making some of the enhancement in terms of to tightening the regulation on GDR. And first of all, it have to be filed 3 days after submitting the application to sell GDR. They also need to disclose if that is, because GDR ultimately the holder can convert it into the local A share after the lockup period. And also, and now they have including a clause that is to say, to disclose if the conversion of the A share after lockup will present any risk to the A share pricing. Because you remember that when they issue the GDR, there's a discount in there, usually about maybe around 10% or less. And then, but this is also coming to attracting some of the investor. They're buying the GDR in Europe and then convert it into the A share. Then they can have a small gain on that. It's quite significant, that part. And also they have to, CSRC also require a issuance report after issuance of the GDR. But most important, there is a see-through approach. They will need to see who is the actual subscriber, and also whether total return swap and other similar arrangement is in place. I think this is also extending to those cross-border conversion, because at the moment they see that there's certain activity using the TRS and then to making the pricing in the local A share market, the same share, that is have to creating the volatility. I think in short, that is, I want to highlight that in some of the attractiveness in the past for GDR in P 2023 May, some of those has been gone now. And then it will be, let's seeing that why, whether this can be still sustainable for this program. And also, so far, give you some idea, why is there such a drop? Because previously there's quite a lot in the pipeline. However, so far we see 7 companies have withdrawn from the pipeline on the GDR. About 6 of them is happened after this new rules has been announced by CSRC. So there seems like some impact between the reduction of the GDR issuance and the CSRC new regulations. So I think I'm a little bit running out of time, and then I will be stopped by here, and then I pass it back to Nickolas. Sorry about my timing.
No, Florence, I think it was extremely good as an introduction. And I'm conscious that Lirenn has a hard stop at 10-hour time, but maybe I can just ask 2 or 3 short subsequent questions to remind everybody else to just also come in on the Q&A. But from listening to your fascinating presentation, I had one question I was interested, well, I've got 2 actually. One is, you broke down kind of foreign investments and the evolution of foreign investors coming into the Chinese market, the mainland Chinese market. Do you have a bit of a breakdown? How many of these are American investors, European investors? Are there Asian, South Asian investors or Middle East? That would be interesting if you've got any information on that. And then you talk about capital outflows, and in the past there were issues around the ability of taking money back out of China. And I think it'd be interesting for the European audience to understand how kind of the capital restrictions, the foreign exchange restrictions have changed in relation to the investments in these companies. Thank you.
Right. Yeah, no problem. For your first question about those foreign investor, so I think you mean the QFII, those is applying for QFII. There's definitely some of those is from Europe, but I don't have the breakdown. I think can afterwards we can share with the audience in our sharing package. But definitely have, because at least I have a few that is from the UK and also from France and so on. And then there's a mixture of hedge fund and also traditional asset manager as well. But you are right, Middle East as well. You can see there's so much headlines about Middle East investors' interest to China. For the second part about the capital outflow and the repatriation, I think last year is we in the industry, we saw that it is a very good testing, because so far we don't see any problem for capital taking it back. As long as you are in those QFII or Stock Connect, it is very smooth, and then client can once they sell the shares, then they can just repatriate back.
Thank you. Can I just stop for one moment to see whether anybody else has questions for Florence at this stage? I mean, we might come back to you later. Just see. If that's not the case right here now, and I'm not surprised given the very comprehensive and very good quality presentation, then I would pass over maybe to Lirenn to talk a little bit, building on this, on the bond market and Swap Connect developments.
Okay, thank you, Nickolas. Andreas, if you could share page 1 of the northbound workflow,
yes.
PDF, that'd be great. That's right.
See, good. Yep.
Okay, excellent. That is the right one. It's a little bit out of focus though. There we go.
Oh.
Perfect. Again, thank you, Nickolas, for inviting me to speak at this webinar. Just to introduce Tradeweb a little bit more, not all of you may be familiar with who we are. We are a OTC electronic trading platform founded about 26 years ago. We provide investors globally with access to different markets across the globe and bring to them the advantages of electronic trading. Today, I'm here to speak a little bit about different fixed income connect programs that China, together with Tradeweb, have implemented. The one thing I want to do and echo a bit of what Florence said is that markets may have ups and downs. Investor interest may wax and wane, but I think the trend from China is explicit and very determined in terms of the implementation of these connect and cross-border programs over this extended period that Tradeweb has been involved in. Just to give you an example, Tradeweb was the first platform to implement Bond Connect in July 2017. That is bookended by being one of the first platforms to implement Swap Connect in May 2023. But in between, we had COVID, as mentioned by Florence, and during that period, we had the implementation of electronic CIBM Direct Link, and we also had the implementation of Southbound Bond Connect. So really, the trend here is very clear. China wants to connect to the world, wants to connect its bond markets, its fixed income markets to the world, and it's doing it in a very sort of determined and structured fashion, right? To connect the fixed income markets. Going to Bond Connect. Bond Connect was indeed the first of the fixed income connect programs implemented in July 2017. Tradeweb did have a very, very, call it the front runner and initiator role in the implementation of that. What Bond Connect does is it allows offshore investors to invest electronically into the onshore bond market without actually coming onshore, and vastly simplified that process for them. Hence, it quickly caught on and became very popular. What you have in front of you is what we call, maybe like a workflow diagram or an infrastructure diagram to kind of explain very, very briefly what it is. In fact, Bond Connect is two connections. One is a trading connection between Tradeweb as the offshore trading platform that faces the offshore investors, and the CFETS onshore trading platform that faces the onshore market makers, right? So Tradeweb connects the CFETS, that is the trading link. Secondly, there is a settlement link that is a connection between Hong Kong's HKMA CMU depository and both the onshore CCDC with China Bond and Shanghai Clearing, right? So the way that this works is that Tradeweb is connected to CFETS. It brings the orders from offshore investors onto the CFETS platform. That is then seen by the liquidity providers onshore. The liquidity providers provide a response to that quote request. That quote request response is then sent back from CFETS to Tradeweb. The offshore investors see the quote request responses on Tradeweb. They pick the price they like to transact on, they would like to transact on. And that message is then sent back to CFETS. And if the quote response from the onshore market maker on CFETS is still valid, then there is a match. And you can see from the diagram here in arrow number 3, that match is then sent down to CCDC or Shanghai Clearing, depending on where that bond is deposited, right? What happens here, I won't get into too much detail, but there's a link between the CMU in Hong Kong and the CCDC and Shanghai Clearing onshore. And as a result, offshore investors, while staying offshore, leveraging their connectivity from the CMU clearing and settlement members are able to obtain custody and settle the bonds offshore. I think where we are today, what I want to talk a little bit about is where we are today is, I think we started out with about 18 market makers in July 2017. Today we have about 59 market makers, so the liquidity is vastly improved. We have extended the trading hours. Market hours today are 9 a.m. to 12 noon China Standard Time, and then there is an afternoon break, and then it starts again at 1:30 to 2000 hours China Standard Time. In the beginning, this was ended at 1700 hours, but obviously because of European client demand, those market hours were extended. The trading protocol remains a disclosed RFQ to the dealers. So when the inquiry comes in from the offshore investors, the onshore market makers know who they are responding to. The enhancements over the years have been quite numerous. Just to lay out 3 of them that have really been a little bit game-changing in terms of allowing investor adoption. Number 1 is block allocation. So this is really something that global asset managers require to be able to invest in the market across all their funds and at the same time prove best execution. Number 2, in order again to increase adoption, we needed more pre-trade transparency. So streaming prices, streaming indicative prices from the onshore market makers, that was instituted as well in order to increase adoption. And finally, a third one, which is quite interesting, as China's bond market has entered the indices, global bond investors have been subject to month-end rebalancings and so forth. What we have introduced to try to accommodate that is our automation tool. So we first introduced automation or auto execution via our AIEX trading protocol to the China bond market at the end of last year, and we've seen a lot of adoption from global investors, especially the asset managers, especially during heavy periods of portfolio rebalancings during month end. Just to end off on Bond Connect, what are the outcomes, right? One of the outcomes, which was something that we together with CFETS, when we designed Bond Connect, one of the outcomes we wanted, and we knew that they wanted, was for the eventual inclusion in the Chinese bond market in the major global bond indices. So that has come to fruition. In fact, China is now included in all 3 major indices: the Bloomberg Barclays, Global Ag, the JP Morgan Global Emerging Markets Bond Index, and also most recently the FTSE World Government Bond Index. As a result, foreign holdings in the Chinese bond market, when we started out Bond Connect, was about 840 billion. And as of April 2023, that has increased to RMB 3.17 trillion. Right? Now, I think that's really what I wanted to say about Bond Connect. Andres, if you could switch now to Swap Connect, page 2 of the slide, please. Okay. This is the latest implementation of the Connect program, which is Swap Connect. What this allows, it's actually kind of the same concept, except a lot more complicated because it is interest rate swaps. Basically, it is an infrastructure, a new infrastructure that allows offshore investors to participate in the onshore interest rate swap market. Now, obviously, there is already an offshore non-deliverable CNY IRS market. However, the onshore market is very, very liquid. Bid offers oftentimes can be tighter, so cost of transaction is more efficient. And as a result, there has been demand from offshore investors to participate in the market. And this infrastructure was built in such a way to allow that. Right. So again, looking at this diagram, there are 2 links. One is a trading link between Tradeweb and CFETS. And then secondly, and more interestingly in the sense that this is uniquely the only CCP to CCP connection for interest rate derivatives in the world. Extremely complicated implementation. Won't go into too much detail, but in fact, there is a clearing and settlement connection between Hong Kong Exchange's OTCC and the Shanghai clearing. right? In fact, so what happens here is that, again, much like we talked about, offshore investor sends quote requests to onshore, onshore dealers respond to quote requests, offshore investor accepts the quote request that they wish to trade with, and then what happens is that CFET sends transaction details to both Shanghai Clearing and OTC. Very, very briefly, this was launched first in 15th of May, 2023. So this is quite brand new. It supports 3 indices, the 7-day repo, 3-month Shibor, and overnight Shibor. The clearing tenors, this is 100% cleared on Shanghai Clearing. It's cleared up to 10 years, as per available on Shanghai Clearing. The trading protocols that are supported are more than that is supported by Bond Connect. One is the traditional RFQ, and the other is the click to trade, where investors are able to click onto firm prices that are provided by the onshore market makers. Today we start out with 20 dealers, but as I alluded to in Bond Connect, where we started with 18, the expectation over time is for that panel of market makers to increase substantially. The trading hours are 9 to 12, and then 1:30 to 5 p.m. China Standard Time. Now, the one thing that is a little bit different, because this is this infrastructure is designed for offshore investors to be able to hedge their onshore hedge their onshore fixed income exposure, and not for speculation. Number one, to qualify as a member of Swap Connect, you have to have a CFETS ID for either Bond Connect or CIBM Direct, right? Which proves that you are an investor in the onshore program. Additionally, there is a 20 billion RMB net notional quota per day. So where are we today with this brand new program? As I said, it's still early days. We see a bunch of activity from offshore banks hedging onshore their offshore market making activities. We are starting to see and have activity from real money offshore, taking advantage of the tighter bid offer spreads. But there are lots of enhancements that we still need to put in, much like Bond Connect in the early days, and those will come pretty fast and furious, over the coming months and years. I think for me that is the presentation.
Lirenn, very, very interesting indeed. Again, I've got a number of questions that came out of that very interesting presentation. But I just wanted to first see among participants on the webinar whether there's any reactions or thoughts. I think we must be very comprehensive, or it's very early in the morning here. I should say in defense, it's very sunny outside, so I assume many people are kind of skiving off. But in any case, let me start then. I think, come back to Bond Connect. Maybe it's just my ignorance, but what type of bonds are covered by this? Is it sovereign bonds? Is it corporate bonds? Is it a combination of both?
Yeah, so apologies for that. That was an omission. I should have been clearer. Bond Connect provides access to the entire CIBM, the entire Chinese interbank bond market, which consists of, Chinese government bonds, policy bank bonds, credit bonds, CDs, so on and so forth.
And do you have a bit of a sense as to the breakdown between the different types of bonds as to what's kind of in highest demand? I guess sovereign might be the highest, but I don't know. It'd be interesting.
I think from what we can tell, and also very much driven by index inclusion and the global asset managers. The majority of the bonds that are being invested in and traded around are going to be Chinese government bonds and public policy bank bonds.
Thank you. Interesting. The other thing I noticed in that presentation and on that slide is the reliance on global custodians. And so I just find this interesting, given the uniqueness of the Chinese market. Are these bonds kind of kept in global custodian structures, so they're kept kind of effectively offshore from a Chinese mainland perspective?
No, there are not. So, I to get into this, I'd really have to explain the structure a little bit. And so what happens is that the bond is custodized onshore, eventually in either CCDP / China bond or Shanghai clearing. There is an agreement between the HKMA and the PBOC to essentially allow the HKMA CMU to become a member of both of these, acting like you might almost call it like a super custodian, right? So now CMU has come on shore and has become a member of China Bond or Shanghai Clearing. Now, CMU itself has members, right? So these members might be, for example, Florence's company, HSBC in Hong Kong, or all its other members, right? And those members themselves have customers who are global custodians, right?
Wow.
So the bonds still live onshore, right? But they live onshore now once they're purchased by Bond Connect investors in CMU's account in either CCDP or Shanghai Clearing. And as such, they then tree up through the structure I described to be visible by the global custodians. Does that make sense?
Yes, it does. No, very interesting. Thank you. Yeah. I see. Maybe me kind of jumping again. I kind of, as I say, please don't be shy. Participants come in. But maybe if I switch to Swap Connect. So I found that interesting because, as you say, it's a very, very new development. And you say it's currently focused on interest rate swaps. Obviously, I can imagine over time you might want to move that to other asset classes as well as it becomes a success. But the one point I didn't quite understand, you mentioned a minimum, I think, notional trading value or covered value per investor, recognized investor.
No, it's not per investor. It's a total. It's total activity.
So
right.
Speculation versus hedging, which has been a bugbear of the European debate ever since I worked in financial services. How do you identify one and not the other? Maybe you could elaborate on that a little bit.
So to address, I mean, to address that concern, to be able to access Swap Connect, you must have a CFETS ID for either Bond Connect or CIBM Direct. What that is really saying is that, yes, I am a bond investor before I can have access to Swap Connect. So in a way that's addresses the speculation versus hedging or speculation versus risk management, right? So that's one. And to clarify my statement, the 20 billion notional is not per investor. That'd be a lot. The 20 billion notional is across the program, meaning the notional of pay minus the notional of receive, or vice versa, is 20 billion.
Okay, interesting. Good. Let me see. I give the audience one more chance to ask questions or raise issues with Lirenn. I think otherwise, a big thank you. I found this very, very interesting, particularly also on Swap Connect, as it's such a new development. And then I might pass on to you, Celine Luo, to talk a bit about the wider developments in the fixed income. So we take kind of a perspective a bit out again into the broader market developments. Celine, thanks for being with us.
Yes, sure. Thank you, Nickolas. My name is Celine Luo from Standard Chartered Bank Financial Market Structuring Team. I've been working in Greater China fixed income market for the past 7 years. So let me share my screen. All right. I would like to go through the latest development and the evolution of this China fixed income market for 2023 in the next 15 minutes. And after that, we'll take your questions. So before we look into the China onshore bond market, I would like to first go through the top 5 highlights with you in this market. I would like to first look at the evolution of offshore dollar bond market by Chinese issuers, also known as Chinese dollar bond market or Kung Fu bond market. This is an important channel for offshore investors to get exposure to China without going actually into the China onshore market. Until now, it is still a $800 billion bond market. However, the issuance volume, we noticed that it started to diminish in 2022 due to multiple reasons. Although it remains stable this year, we think that the outstanding market size will decrease. The AT1 are called and not rolled. A lot of stress happened on the high yield space. And we think that the refinancing of these Chinese issuers are heavily switched to CNY instead of dollar, which leads to my second point that I would like to highlight. The interest rate spread widened between dollar and China again this year. While most of EM market, EM countries are keeping the interest rate high, China is heavily decoupled in this Fed's rate hike cycle. The onshore rate is around 2%. Major Chinese banks can raise uncollateralized interbank liquidity at around 2.3% in CNY at 1-year tenor. When we look at corporate financing business, the loan prime rate 1 year, which is a benchmark used for all the mortgage loan and corporate loans in CNY, it was cut 2 times 10 bips this year to 3.45%. So the refinancing is cheaper, and which is in favor of asset generation in renminbi instead of dollar, which is in favor of bond issuance in the onshore market, but also in renminbi in the offshore market. So my third point is the booming dim sum bond market, which is the offshore renminbi issuance market. So this has caught our attention that this market volume, excluding CD issued by major Chinese banks, is currently reaching $200 billion size, with an annual growth rate of 30% over the past 2 years, assuming the same pace of issuance until year end. So one would think that the dim sum bond market is here to replace the Chinese dollar bond market for the refinancing of Chinese issuers. But is it so true? If we look at the percentage of Chinese issuers in this dim sum bond market, we notice that the ratio of Chinese issuers falls from 72% in 2019 to 55% this year. So basically, volume of dim sum bonds issued by Chinese issuers is stable over the past 5 years. However, we notice that foreign issuers becoming more and more active in this market, typically foreign banks from UK, US, Hong Kong, France, etc. So dim sum market is not only a substitution of Chinese dollar bond market in a sense of northbound investment, so foreign investors investing in China assets, but it is also becoming a channel for southbound investment. So Chinese investors are using this bond market to invest in foreign investors in foreign issuances. Let me show the point for steady southbound bond connect flow. Southbound bond connect was launched in September 2021, and it became quite active last year. This year, the net flow is steady. We still see big volume of outflow. So The southbound Bond Connect scheme came with an annual quota of 500 billion CNY. This is the net position, so the cap is on the whole market. There is no individual cap on any investor, and the investor qualification is there for any onshore established banks. There was a question mark at the end of last year whether the quota of 500 billion CNY is to be renewed every year, because at the end of last year we were almost there. But I think currently the market is more comfortable with this quota that we think would be reset annually. So if we look into this change of trend from northbound flow to southbound flow, we understand that China is becoming, in addition to a asset origination market, it is also becoming a distribution market. So basically, we are saying that China is having an additional item to export, which is a financial service. For instance, in southbound Bond Connect, although the custodian route is also possible, we see that a lot of Chinese investors do have a preference on CMU routes. So we are promoting the CMU routes in which the China onshore investors are investing through Shanghai Clearing House. The whole infrastructure is to be exported to the international financial market. Now, when I rethink of the slogan, renminbi internationalization, previously we were talking about China access routes, offshore investors investing in China onshore assets in renminbi. But now with the growth of this offshore CNH market, we see a wider scope of global application of renminbi. And also, I think a bigger ambition to promote a whole set of infrastructure and financial service. A last point to show, so the point 5, the same idea is the growth of Shanghai Free Trade Zone bond market. This is a very small market that exists since more than 5 years. Issuance volume was never big, but since last year, it significantly increased, and it's more than doubled in the first half of this year compared to 2022 full year. The infrastructure is very local. Bonds on Shanghai Free Trade Zone bond market are cleared mainly through CCDC currently. While this market is aimed to cater to international issuers and buyers. For instance, issuance on this market are under international laws. The documentations are all in English, etc. So the setup speaks for its purpose. Now, some might challenge that the issuance size goes to almost zero after end of June this year. I think this is because the main investor in this market is still Chinese investors, including Chinese banks, onshore and offshore branches. And it doesn't really fulfill the goal of this market, which is to serve to international investors. So why there is a control or a stop on this market, I think it is also related to this because the goal is not achieved. Okay, let me go to the onshore market now. So we are talking about northbound China access. This page explains the difference of the three main channels to access to the China onshore fixed income market. But I will not go through this page because basically this slide is what we show to confuse people. This slide is much easier to understand. Basically, CIBM Direct is for pro players. It provides a full access to not only bonds but also hedging instruments in the CIBM, so China interbank bond market, which is the largest China bond market. Bond Connect provides a light version of CIBM Direct. Its application is simpler and faster. However, the instruments will be limited, so the bond scope is intact, but the hedging instruments, the derivative, and the repo possibility will be removed in the Bond Connect scheme. And QFII is the favorite wrapper by asset managers, especially cross-asset, because it is the only scheme that allows to invest to various asset class across fixed incomes, shares, and also extended to commodity now. If you ask me what I have to update today on the northbound channels, not much except the enablement of Swap Connect and also the extension of the QFII scope to selected commodity underlyings, which was already covered by Rin and Florence separately in their session before. This is also because in the past decade, there was several optimization and the relaxation in rules under each of the channels. So nowadays, it works very well. Let me go to the last part. I would like to navigate a few topics that I was noting. I think I have an issue with this slide.
Issue with this, but yeah.
I guess you see nothing, right? You see a blank page?
Nothing. No, we don't see anything at the moment, Celine.
Okay,
Otherwise,
let me.
through.
Yeah, do you mind?
Do you want to try again?
I can share it for you.
Yes, let me close and try again. It is the last page, so.
Yeah, try. Otherwise, Andy can try and share it for you.
Let me try again.
Of course.
Can you see it now?
Yes. Excellent.
Okay, great. Yes, so 3 topics that was noting. So first, the regulatory framework around derivative transactions. Some of you might still remember a consultation paper launched by 4 Chinese regulators with regard to China derivative market. The consultation paper was out in December 2021, and immediately there was a lot of debate and comments raised to each regulator. After a few survey and a round of feedbacks submitted to various regulators, we didn't hear back this year. We think that with the reorganization of financial regulators in China, this project will have low chance. The market would expect rather to have a update in regulation around the derivatives rather from each regulator, for instance, CBIRC and CSRC. I think each of them is working on the update in derivative law rules separately. I know that the contents regarding cross-border derivative transactions in the previous consultation paper was drawing a lot of attention from international banks. I do not think any of it will be entering into and will be effective very soon. The second point, the capital rules for commercial banks in China. So in February this year, CBIRC, the bank regulator in China, launched a consultation paper for new capital rules for commercial banks in China. We noticed that a lot of the rules are in line with the international rules or practice. We do not expect large deviation from CBIRC in this specific rule. Although we notice that some of international rules, when it is quite complicated, was cut short. Some comments are also raised regarding these, some nuances regarding TIS, for instance, and we have no timeline for the new capital rule to be officially announced. Now, regarding the margin system for uncleared OTC derivatives in China, after the China netting becomes effective. So we understand that it is a big concern from major international banks to enter into CSA with Chinese financial institutions, especially the major banks. I think the big concern was rather last year. This year, I think major Chinese banks made a great effort to mobilize their internal efforts from legal, from operational, and from modeling. I think the major Chinese banks are ready to sign CSA. Now, which type? We still have quite a lot of challenges. VMCSA might be the easiest. When it comes to IM, because of the difficulties in modeling of complex derivatives, because of the infrastructure requirement, the Chinese banks might still need some time. So we notice that foreign regulators are giving grace period. From UKPI, for instance, it is 1 year. For Hong Kong, for HKMA, it is not explicit, but a reasonable time was the exact word. And the grace period will kick off from the time in each bank that the China netting is activated. So it really depends on the speed of preparation in each bank. So we think that the next step will be, so first for the eligible Chinese banks to arrange legal efforts to sign CSA with foreign banks. And also there is a good ask from the market to use Chinese government bond CGB as collateral. On that side, I think there are multiple challenges. We mainly look forward to work with CCDC to overcome the obstacles. So I will stop here.
Celine, thank you very much, and particularly also the last part I found really, really interesting. As you say, we moved into some of the issues on which there have been much more attention, international attention on treatment of derivatives including quality of collateral, margining, and just the possibility to trade derivatives in the Asian market. Very, very interesting. Actually, one question on that. As you say, there are the four regulators. We now have to see what the four regulators will say based on the end 2021 consultation. One of those, I guess, relates to commodity derivatives, doesn't it? Because I've seen particular interest around the emergence of commodity derivative markets. Also, in general, I think an interest in China developing a much more sophisticated commodity market, spot markets. Maybe you can say something about that.
Yes, sure. What I know of is that the idea to include commodity underlyings in QFII was spoken for at least 3 years before it actually becomes true. And when it is becoming reality, there is a additional rule, a commitment letter attached to the QFII scheme for QFII investors willing to access to China onshore commodity market. They are asked to sign a letter to establish that they will not use these transactions as hedge of structured products, such as my interpretation is such as TRS products. So I think there was an effort to control the cross-border conversion and to prevent the misuse of the access products, the access schemes. Now, when the reason why I mention this is because this explains the focus on commodity underlyings in China, especially under the regulation of CBIRC, which is now NAFR after the reform. After the oil incident with Bank of China, actually commodity becomes a highly regulated space. So that is why even for QFII, when such commitment was never in the spirit of regulator for any other asset class, it is required now for commodity.
Thank you. And maybe a question both to you and to Florence. I think Lirenn made an interesting point at the beginning of his presentation. He effectively said that, the trend for the further evolution of Chinese capital markets is clear. In a way, he was kind of looking into the crystal ball without I'm not expecting a clear prediction as to what steps exactly are taken when.
I think, yeah, for this year, particularly in the fixed income market, maybe some of the speaker they mentioned that is everyone is quite look forward to two major events. One is on the bond futures, and then the other is about the repo market. I think especially on the China repo market, it's been one of the key items that is asked by international investors for a long time. And I think it will be a very good news if a Chinese regulator will make the comfort and offer to all the international investors, because the China repo market at the moment is only open to sovereign types or the central bank and some of the RMB participating bank, RMB carrying banks. But while most of the mainly the asset manager, and then they have been also asking for this, not just insurance asset manager, having commercial bank as well. So I think this will be a quite game changers if eventually we can see the launch or extending this China repo market to all the international investors. Bond future as well, then I think in quite a few of the occasion, there's already, for example, the Hong Kong Stock Exchange and Chinese authority also mentioned about, hopefully this is on agenda and then we can be seen in the next few months. We are also hopeful that is by this year and we can see something coming out as well from China. I don't know whether my fellow speaker, they also have a different will or some other things they would like to say as well.
Yes, I think the opening of repo to international investors is long expected, I would say. Not only the onshore-offshore liquidity situation has a huge gap, which creates market opportunity and also needs for both onshore and offshore participants, but also itself as a liquidity instrument will be very important for offshore fund investors, mainly to consider this market. I would also like to highlight a opportunity in China credit market, the credit derivative market. This market was closed to offshore investors so far. It slowly grows in its size and has developed multiple tools that has no international equivalent. For instance, CON in China, so credit-linked note is considered as a credit derivative in China. And therefore, the onshore CON cannot be sold to international investors. But with the growing of this market, the effort being led by NAFMI, the rules has been largely optimized. And this year, China might form its DC just as ISDA, so Credit Determination Committee. After that, I would like to see if China is willing to open its credit derivative market to foreign investors, which will inject a lot of liquidity and market depth to this market.
Interesting. Yeah, that would be interesting to see. Obviously, we had international in the US and Europe our own fun in 2007 and 8 with credit markets. So it'd be interesting how much appetite, because it would require also much more demand for transparency and arrangements for the underlying. And I think that's an interesting challenge or dichotomy that we would have to address in the Chinese market. It's interesting. Which brings me actually to, from my side, my last question before I also pass over to Jennifer, is ESG, environmental, social governance criteria are becoming more and more important in the global debate and the European debate. If I look at green bonds, China was actually one of the leading markets for green bonds. We were among the first jurisdictions developing standards around green bonds. I'd be just interested, both from the equity side and from the bond and fixed income market perspective, what's your perspective as to, A, the appetite of mainland Chinese investors in looking at kind of green designated or labeled products? And to what extent is kind of that demand for green products shaping overall the structure of the markets that we've been discussing today? I know, Celine, whether I put you on the spot there, but I remember being in Beijing. We organized our roundtable, an event in Beijing. It must have been 2017, and your vice finance minister spent a considerable time explaining the green bond standard framework to us.
Yes, maybe I can give my 2 cents on the China clean bond market. So
I think we've just. I thought my question was so difficult, but it wasn't. I think it was more a technical issue. Maybe, Florence, I can pass over to you and we can see whether Celine comes back in a moment.
Yeah, I have to declare that I'm not the expert in this area, but interesting timing you're asking this question, because in Hong Kong, they just have arranged that is the green bond to issue. And then you know that in between China and Hong Kong, it's one country, but there's a lot of the testing ground, and then there's a lot of the leading project. They will usually use Hong Kong as a start as first. And then in this week, we saw that there's a 2 tranche of the green bond will be issued with the Hong Kong SAR government. And then we are quite lucky. HSBC is one of the participants will be in the issuance as well. So I think there's no doubt China would like to push this agenda. And also this is fit into their long-term vision about to reduce and also to meet their carbon neutral. And I think this is still ongoing. It's no dropout at all for the green bonds. And you see that also PBOC, Mr. Margin, and then he's in also a very key advocate on this particular subject. So sustainability. Also China, I think they also want to leading for some other EM market in this space as well. So to set a model and then on how the project can be the fund can be financing some of the project in China or in some other country.
Thank you, and good to have you back, Celine. For a moment, I wasn't sure whether my question was so difficult or whether you because you suddenly froze. But back to you. Clearly, it was a technical issue.
Apologies for the connection issue. Yes, so regarding the clean issuances, I understand that China has its own standards, and this is a top-down effort for China to promote green business across lending, repo, and the bond issuances. So it was in China market that I learned for the first time that there is not only green loans, there is also blue loans. So they not only promote green label, there is actually a set of local labels to promote these financing instruments. Double labeling is possible and is currently in use. Consulting firm can provide independent opinion on the verification of the green criteria, because the greenwashing is also under spotlight in China.
Thank you. And that's actually one of the subjects of one of our upcoming events that we're going to organize, which is exactly about how supervised regulators look at greenwashing. So that's a very nice transition. Thank you to the two of you, but Jennifer, I think I'll pass over to you.
Thank you, Nick. Well, first of all, I would like to thank our panelists, so Florence, Celine, and Lirenn, for their participation in today's webinar. I would also like to thank you, Andy and Nick, at Afore for organizing the event, and the members of the EU-Asia Financial Services Regulatory Dialogue who make events like today possible, and clearly underline the importance of regulatory dialogue and cooperation between the EU and Asia. As my colleague at Tradeweb, Lirenn, said, and I know, Nick, you picked up on this as well, the trend from China is determined. And I would argue that this isn't just a trend, this kind of determination in China, but really applies to the wider Asia region. What became clear to me today during the webinar is that while each market may have their idiosyncrasies, we are really more similar than we are different. The point is that we all wish to create resilient capital markets that can unlock funding to stimulate growth and open up investment opportunities for citizens and business. This point was clearly evidenced by Florence's example of international companies that are increasingly interested in dual or locally listing shares in Asia and Chinese market, and the relaxation of bond access rules, as mentioned by Celine. Last but not least, I'd like to thank all the participants who joined us this morning. We hope you found the webinar insightful. And if you have any feedback or suggestions, please do not hesitate to be in touch with Andy, Nick, or myself. On that closing note, Nick, unless you have anything else you'd like to add, I'd like to wish everyone a great rest of the day and our colleagues in Asia a good evening. Thank you.
Thanks, Jennifer. Thanks, Florence, and thanks, Celine, for being with us. And of course, Lirenn, in absence, I know he had to dial out just a short while ago. Thanks, everybody, and see you in the webinar. All the best. Bye.
Bye then.
Thank you. Bye-bye.